Hi, this is Hyperwave. I do have a broken foot, so this is a bit of a jerry-rigged situation, holding you guys live in my hand, kind of like a selfie stick. And this is going to be so much fun. So Tyler is going to explain all things Consensio. And with that said, I'm going to be off screen as much as possible today, and we are going to listen to Mr. Ty. Thanks so much for joining us today, guys. All right, Ty.
Great. Thank you very much, Leah. Feel better. Get some rest. I hope I don't drone on too long. Try to stay awake. This is an important one, I believe, because we've had so many people interested. And I realized when I looked back at our past vlogs how little we were able to cover. And anyone that has come in the last month or two probably hasn't heard anything about Consensio. Consensio is a very simple system, but it's very powerful in that you can use it for any asset class, anytime, over any time period. Very short term, meaning down to minutes, to very, very long term, which is the way I'm using it in general. And it's using the simplest of all technical tools, which is the moving average, but it uses it in a different way than most people use moving averages. Most people use 14-day, 50-day, and 200-day simply to get an idea of where support and resistance might be, either below or above price action. But over the years, I began to realize what a powerful tool it was if we just understood a little bit more about how various moving averages of various time frames interact with each other. Now, what I've presented before is just a very simple diagram of a sine curve that includes a bull market on one side and a bear market on the other side. And I show what has to happen with moving averages to get from the first to the second. How do you go from a bull market to a bear market, or a bear market to a bull market? And we're going to review that in the next 10 minutes, just to bring up to speed anyone who was not involved in those earlier discussions. But then what I'm going to do is I'm going to expand greatly the analysis, and I'll give you the background as I do that of where it came from and how it can be used, and why when you talk about Consensio, you're not simply talking about a short-term moving average and a long-term moving average in price. You're actually talking about much more than that. So I'm not sure how much time we are going to, I am going to excuse myself for 30 seconds because there's someone at the door, and I promise I will be right back.
So I will unmute myself, but totally not show you guys how bad this leg situation is. But I'm quite literally in a machine that helps bend it so that I don't get blood clots. Woohoo! So with that said, if anyone wants to send through a joke, this is like the Tone's Tone stepping in. If you guys have been watching, Tone is at this very interesting festival called Pork Fest, and been taking interesting videos. And now we got Tyler back.
Okay, I am back. And
popsicles.
Thank you very much. Okay, so what we were saying is that we have reviewed what I call the sub-conditions of the Consensio system. And those sub-conditions make a lot of sense when you see them the first time in a sine wave. The problem is, as many of you probably have already recognized, is it's very disingenuous to look at the movements in markets as being perfect sine waves. It almost never happens. So yes, it's easy to show what happens in Consensio as you go from subcondition A to subcondition M. But what is not said in that basic look is how complicated it can really get. So enough of that sort of talk. I'm going to bring up the charts that we have looked at before in a little more color and a little bit better presentation. It's probably very difficult to see the lines on this because of the colors, but I will just explain what you're looking at. Subcondition A in Consensio is a bull market where the price in blue is above the dotted line, which is the short-term moving average, and the dotted yellow line, which is the long-term moving average. So you've got price, short-term moving average, long-term moving average, and a sine wave. A sine wave meaning just what you learned in geometry and simple math, trigonometry, where the wave is equal from top to bottom as it is from bottom to top, and then repeats itself. And what we do is we then move through all of the stages as price begins to go down, and that's subcondition B, where it cuts through the short-term moving average. And then C is where the short-term moving average begins to roll over and is no longer going up. And then D is where the price is below the short-term moving average, but it's the same as the long-term moving average. The short-term moving average is still above the long-term moving average. Now, for those of you that haven't seen this before, it's very simple to visualize, but the best thing to do is just take out a piece of paper and a pencil and just draw a sine wave, and that will be your price. And below it, draw a second line, and that will be your short-term moving average. And below that, show a third line, which will be your long-term moving average. And remember that price is going to always drive the short and the long-term moving average because the definition of a moving average. And the example that I used before was a 10-day moving average. The calculation is exceedingly simple. You can't have a 10-day moving average until 10 days go by. The first 10 days of a chart of price, you can't get a 10-day moving average. On the 10th day, you can add up all the prices if you're using closing prices or high prices or low prices. That doesn't matter. But let's just say the closing price on 10 days, you add those 10 prices together and divide by 10. And you plot that point. That's the first point of your moving average. The first 9 don't have anything. The 10th one has got 10 days averaged. And that's why they call it a moving average. Because on the next day, you're going to drop day 1 and you're going to add day 11. And on the next day, you're going to add day 12 and drop day 2, etc. So it moves along as the prices come in. And what's important about Consensio is being able to visualize this basic movement in a sine curve. Because as we get down through E, F, G, H, I, J, K, and L, each of which is just an incremental step, what you find is you have shifted from a bull market through a bear market and back into a bull market again. And it works perfectly. The only problem with this as a vehicle to try to understand the price movement of moving averages is how rarely it occurs in real life. There's plenty of times you can find a bull market as it rolls over. And take a look at the Dow or the NASDAQ or the gold price, any of those things, and just look at the trending market. What this is trying to do is it's trying to get you to think about what it takes to get out of a trend. Out of a trend in Bitcoin from a bull market until December 16th into a bear market, which began shortly after, depending on what technical tools you're using. And the question today for us all in the crypto world is, when is this bear market going to end? And my answer is no one knows. I have targets from other systems like Hyperwave. Other people have targets from systems like Elliott Wave. Tone has targets based on a number of tools that he uses that end up with very similar targets to mine, even though the tools are very, very different. But none of us know. But Consensio knows, and Consensio will tell you when you have moved from a bull market into a bear market and when that bear market is coming to an end. And it will tell you that about the stock market, the gold market, the real estate market, rare horses, numismatic coins, or anything else that is priced in terms of a fiat currency. And it can actually be used if things are not priced in a fiat currency. You just have to adjust your mechanism, your pricing mechanism on the left-hand scale on this particular chart, or the right-hand scale on most charts. So what we're really looking at is the movement of price over time through various patterns. Now, a number of people have been asking me to send these subconditions out, and I have not done that. I have not done that because I wanted to first tell you why it's fairly useless to use these subconditions unless you understand a much bigger picture. So I asked people that saw the original here a couple of months ago to tell me how, if I add a third line, a third moving average, how many combinations of the price and 3 moving averages make up the entire universe of possibilities. Here, with just 2 moving averages, it looks as if there are only 13 approximate possibilities. We've got them numbered from A through M to take you through a full cycle of a bull market, a bear market, and then back into a full bull market again. But in reality, that's not true because markets don't move in sine waves. And this simplicity of the way I have constructed this using a sine wave gives you an incomplete picture. So today what we're going to do is we're going to go into a lot more detail. And I will explain why sine waves are great for understanding the simplicity of the concept, but are not very practical. Half of them are practical, going from the up part of a trend into something else. You can use all the time. I'm using it for Bitcoin right now in a down market. I'm using it in the stock markets that have been in an up market. I'm using it for gold that's gone neutral, but had been in an up market after being in a down market from 1900 down to 1100, etc. So it's a great way of understanding what this thing is that you're looking at, this asset class or this stock or this bond or this commodity or this cryptocurrency. It helps you to conceptualize what's really going on, and therefore it helps you to get rid of your preconditions that we all have about what we want the price to do, or using a system that says, okay, this is now oversold, so I want to jump into it, or this is overbought according to the McClellan oscillator, therefore I want to get out of it. All of those tools are kind of hit and miss without an overall conceptual view of how price actually moves through trends. Okay, so now we're going to go into some detail, not enough so that everybody's eyes begin to tear, but close enough that you will begin to roll your eyes at some point here. Now, let me explain some things about where this came from. Amivest Capital Management was a firm that I moved to in 1991 that managed only institutional accounts, basically in New York City and down in Washington, D.C., and a little bit up in Boston. And it had been around for years and years and years before I ever went there. It was founded back in the 1960s. It got into money management in the 1970s. And I joined the team in 1991. And the firm, I joined as a senior portfolio manager. I already knew all about Hyperwave. I knew all about the sequential trading system. I knew all about Wells Wilder and Gann and Elliott. I'd studied that from the 1970s all the way to 1991 when I joined this company, Amivest Capital Management. The people there did not know or care about technical analysis. It was basically strictly a fundamental house. So I didn't get to use my tools until I was promoted from senior portfolio manager to chief investment officer, where I was in charge of making all of the investment decisions. And because I rely so much on technical analysis as well as fundamental, I got to begin doing real-time research on various concepts. And one of them was Consensio. So this is a presentation that was put together in the 1990s. That's why it looks so old and dated. But it is what it is. Just as when I talked about Hyperwave originally, I showed you what I call the archetype Hyperwave that I drew by hand on a piece of paper back in the late 1970s. And that's the same one that I used to show everybody what a hyperwave was. One of the reasons I'm doing this using these old time presentations is to get you to understand from my perspective that this has gone through a lot of thought, a lot of experimentation, a lot of practical use, and a lot of programming in the case of what you're looking at now in conjunction with Bloomberg. We worked for 2 years with Bloomberg writing the algorithms to convert what you're now looking at into digital code that could reside on the Bloomberg terminal so that we could trade on a daily basis using Consensio in the ETF market automatically without anybody having to make any decisions. So this thing has a long background, and I speak confidently about it because it has weathered a lot of analysis by a lot of people, and it has always been proprietary, though, to me and to groups that I have worked with. But as I did on Hyperwave, I wanted to open it up to the community as another tool in your technical arsenal or your technical toolbox, as just a way of looking at the world that might be different than what you have been exposed to before. Okay. First of all, what we're going to look at is a thing I call directionalities. And I break that down into 3 separate groups: bull markets, bear markets, and flat markets. And it's important to understand what a flat market is. A flat market does not appear in a sine wave. Number 1. Number 2. A flat market is the most usual type of a market in the real world. It is very rare for markets to trend. Markets tend to pulse and then go flat, and then pulse and then go flat. And that is this concept of pulsing that I have been trying to explain on my short-term 5% views of the way markets are moving, particularly the Bitcoin market. But if you pull out charts, a chart book, and just look back into history, including very long periods of time that I've mentioned before, from 1965 to 1982, the market was flat, 17 years in a row. Now, various times during that market, with a peak at 1,000 on the Dow, the market went into a bear market, so you had a downtrending market for a period of time, followed by a sharply moving market in the opposite direction for a period of time, and then more flatness. The same thing happens when you think about Hyperwave in what's called the phase 1 line. Bitcoin, even though it went through these mini hyperwaves, the last one in 14 and 15, basically was flat under $1,000 for 9 years before it took a big move. The Dow Jones Industrial was flat under $100 from 1908 to 1922 before it took off in a big move that happened to be a hyperwave that ended in 1929. I can go on and on and on with the gold market. Tone Vays talks all the time about his dislike for gold because the people that are always talking about gold did so for 20 years without it going anywhere. And he's absolutely right. So that's a way of explaining that you cannot forget about flat markets. They are a part of the reality of the way prices move. And a sine wave presentation of Consensio gives you the green and the red, the bull markets and the bear markets, but it doesn't factor in this important thing called flat markets. Okay, so what is directionality? Directionality means that in a bull market, if you look at long-term moving averages, short-term moving averages, and price, you know by looking at those sub-conditions that one in a directional analysis of a bull market is up, up, up. All three are going up. But look what happens in two. The price is still going up, but it is going up with the short-term moving average flat. What does flat mean? The same price as the day before or the week before or the minute before, depending on what your time frame is. And yes, you need to be flexible on going from up or down to flat, but you know flat when you see it after it's been there for a while. Let that just be a clue in terms of how to think about flat. So number two in this directionality of a bull market is up, flat, up. Number three is up, down, up. Okay, how do you get a short-term moving average to be going down if the price is up? Well, because it depends on the time frame you are looking at. This is not sequential in nature as the subconditions are. This is saying that you will find in real life a condition in which the price dropped down sharply, such as number 7, but did not turn the short-term moving average down or the long-term moving average down, and then the price went sharply back up. And when that short period of down was taking place, it had not yet affected the calculation of a short-term moving average. Because if it's a 10-day moving average and it's down big on one day, it will only be 1/10 of the calculation starting on that day. And then it will work its way through the next 10 days until it is dropped. You hear Tone talking about that when trying to figure out what it's going to take to turn the 30-week moving average down. And you need to go back 30 weeks and look what was being posted there. But in any case, start picturing the idea that every one of these 9 series of things can happen, where you go from up, 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 to up, flat, up, down, up, flat, flat, up, down, flat, up, down, flat, down, and finally at the bottom, the least weakest bull move is up on the long-term moving average. That's why it's still in a bull move, but the short-term moving average is down and the price is down. Now, we've said some snarky things down here in the comments, such as A is bull 1 indicates what appears to be a strong uptrend, up, up, up. But bull 9 indicates that an uptrend appears to be falling apart because it's up, down, down. Bear 1 indicates what appears to be a strong downtrend, but bear 9 down, up, up indicates that that downtrend is coming very close to ending. Okay? And in between all of that noise, this is what's going on. On a long-term moving average basis, flat, flat, flat is number 1. And that simply means that everything has been really going flat. Now, if you look at a minute by minute chart or a hourly chart or a 4-hour chart, it's hard to find any of that because the movement is up and down all over the place. But when you look out at monthly charts, you will find periods that can go for years where the short and long-term moving average are flat, flat, flat. The longer you go, the more these flats become important. The shorter you go, the rarer they become. Okay, so one is flat, 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 and then you go through all the iterations of the ups and downs in between until you end on number 9, which is flat on the long term, down on the short term, and up on price. Because the price is now moving up, it is going to affect the short-term moving average and turn it to a flat. And then it will affect the long-term moving average and turn it to the upside. Okay, I don't expect anyone to get all of that, but I want you just to understand where we're going in the thinking, moving away from sine waves to what really goes on in the real world with price, because that's what you're going to find with Bitcoin and gold and the stock market and anything else you look at if you try to use this thing that we call Consensio. And since there are so many combinations, well over 1,000 combinations, that if you are going to try to program this into something you don't have to think about, it will just spit out numbers for you to tell you when it's time to buy or sell or lighten up or strengthen a position. You've got a very big project in front of you. I don't think it's necessary. What is necessary is to understand the guts behind the thinking, why these basic movements between bull and bear markets are so complex, but knowable. What I'm trying to show you now is my attempt over many years to get to know what is actually going on with just these simple movements of price and 2 moving averages. The third one is very important, but becomes so complex so quickly that we're not even going to go into it. Don't need to. All right. The second group of things, the first thing we did is we did a thing called directionalities. The second thing we call relativities, because now we get to look at the 9 things that go into the subconditions, the 13 things that go into the subconditions, but rather than on chart form, we simply use the terms above, same, and below. Same means flat. But same is a little bit different than flat, because relativities have to do with the sine wave. An intersection of price and short-term or long-term moving average is a point. It is 2 lines coming together at a point. That's why we call these relativities same. That's different than what we just looked at with directionality. If you get more than 1 point, you've got a flat, if it's at the same horizontal level. If you get 3 of them or 4 of them or 5 of them, if they are hours or days or weeks, then it becomes obvious to the optics, to the eye, and to the brain that this silly thing is going flat on me. And it's going to begin to pull the moving averages closer and closer together. That's what flat does. So relativities are not the same as directionalities. Very similar, but not the same. So here, what we do is we break down from A to M the possible combinations in the order that they occur on a sine wave as you go from a bull to a bear market. So you go from above, above, above to same, above, above, below, above, above, below, same, above, below, below, above, below, below, same, etc., all the way through all of the things we just looked at. Meaning all of the subconditions, not the directionalities. Now, I would suggest if anyone is really in sync with where this is going and what it is saying, that you simply recreate it on paper. It's very difficult to read it and see it when someone else has done it. But if you construct it yourself, and it's simple to do, you just have to take time doing it. That's why I ask people, try to calculate what happens if this happens and what's the maximum number of combinations here and there, just to get you going through the thought process. But it's important that you do it yourself. You know, half the followers are already tuning out, but the other half, a group of them are saying this is interesting, and 10% might say, I'll bet I could recreate this and actually create algorithms to do the calculations, and maybe 1/10 of 1% will actually take that extra step. The trick isn't doing the analysis and coming up with the algorithms. The trick is tying into a database that will allow you to program those algorithms into the database in such a way as you can go through past data very quickly on hundreds and hundreds and hundreds of different securities, which is exactly what we did and why it took us 2 years. The database we used was Bloomberg, and we had access to minute by minute, tick by tick charts going back years on hundreds of different ETFs that we were interested in. So anyway, that doesn't mean that you can't get a mental picture of what is behind this thing. And I encourage everyone to do it. And then we will make it available in the form that you're now looking at to help you, think through what steps are necessary and that sort of thing. Okay. Moving on to the next step, which is actually a part of Consensio, and I haven't mentioned it before, but it's very important, and that is relative strength index. The reason I talk about relative strength when talking about Bitcoin in a little bit different terms than you've heard other people talk about it is, once again, and I know some people are getting bored with hearing this, but I learned a number of the basic systems that turned into bigger systems by sitting down with the people that created those original systems. And the RSI was created by Wells Wilder Jr., and he taught it mainly from the perspective of commodity trading. And at the time, I was a commodity pool operator, and I was very interested in it. But over the years, I've learned to use it across a wide spectrum of various securities. Each one has their own fingerprint relative to the RSI, how you want to adjust it to understand what's going on. The more volatile something is, you have to do different things than when looking at the bond market, as is true with all technical indicators. But in any case, in Consensio, after I've gone through directionalities and relativities, I want to understand the RSI movement as you move across each of those different parameters, the directionality and the relativities. As you go from any one to any other one, try to picture in your mind what do you think the relative strength index is doing? For those of you that use and know about relative strength, everybody just looks at it as this wavy line that's in the Wall Street Journal and Investment Business Daily and Barron's, even on some charts. And a lot of charting things use RSIs, but it's kind of a throwaway for most people. It just sits there at the bottom of the page and it's either going up or down, and it's either way up or it's way down. But that's not really what's occurring. If you will suspend your disbelief for a short while about how easy it is to actually picture the movement of price as it moves from a trend into another trend, and how it's always incremental in terms of making that movement. Even though it seems sudden or it seems like it's taking a long time, it's incremental, it's predictable, and it also occurs in a particular order every time. There are no exceptions. And that means that once you've got that firmly in your mind, you can look at these things like directionalities, a bull market that's up, up, up. Where is the RSI going to be? It's going to be very close to 70. Now, the speed with which it got there on an RSI through the movement of price that has the short and the long-term moving average moving up, how quickly the price moved is going to determine how quickly the RSI gets up to 70. So if you've just moved directionally from an up, down, up number 3 through an up, flat up into an up, 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 so you are now fully in a bull market, the question is, how quickly did you get there? The RSI is usually a 14-period moving average. If what you're using is a 30-week moving average and a 7-week, which is what I use on weekly charts, then the RSI is a longer period than the short-term moving average, but only half that of the long-term moving average, approximately. But you need to be able to start picturing in your mind, what's that going to move? I can tell you right now that number one, in a bear market, down, 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 the RSI is going to be close to 30. Where is the RSI going to be on number one in a flat market? Flat, flat, flat. It's going to be 50. Might be 49, it might be 51. In other words, I can predict the RSI movement, and I can predict these directionalities by using RSI without putting both of them together. So now all of a sudden you begin to see the link between various technical trading systems and other trading systems. They don't stand on their own. Tone uses the sequential system with his variations as the third most important technical indicators he uses, not the first, because he uses the shape of a candle first, the shape of multiple candles and formations second, and thirdly, he uses the sequential trading system. So when you see me making projections based on Hyperwave, based on Consensio, based on RSI, they are not independent of each other. They are, in my mind, different aspects of exactly the same thing, which is the movement of price. Okay, I don't want to get too philosophical here, but I want you to begin to see how these things move together. Now, relativities move the same way relative to RSI. I can be pretty darn sure that A, above, in terms of this relativity, is going to be very close to a 70 on an RSI, once again, dependent on the speed with which the price got you into this position from the lower position. Now, the other thing that happens with RSI that's very important is that RSI tends to, by the way it's calculated, to diminish from an overbought position without the price going down, but simply by going sideways. And it tends to increase from an oversold position of 30 or 25 or 20 or 15 simply by going sideways, what I call a flat market. So that's why I say the speed with which you got the signal on the directionalities or the relativities, the speed with which it came will give you the clue about where the RSI will be. The quickest way to see where the RSI is check the RSI. But don't just check it because it's a wavy line at the bottom of the page. Check it in such a way that you're trying to see what is going on those directionalities and relativities above it because of what the RSI is now showing you. And one will help you understand the other, and the other will help you understand the one. Okay, so I've grouped these into three categories, just high, moderate, and low. And then I've got this little verbiage here to describe the condition of the fund such that the long-term moving average and short-term moving average of that particular fund or stock or commodity or crypto is rising and the price is above the short-term moving average, and the short-term moving average is above the long-term moving average, and the RSI is high as opposed to high, moderate, and low, one would say the condition is bull 1A alpha. And that simply gives you a description of the three things that we just looked at, including the sub-conditions, the directionalities, the relativities, and the RSI. It's just a shorthand way which you can then, without drawing all kinds of charts and graphs and sub-conditions and charts, just use four basic symbols to understand exactly where you are. And that will lead you to understand better what you're looking at on a chart in terms of making decisions about what those moving averages are really telling you. Now, I'm going to switch over and I'm going to use Bitcoin wisdom, and I'm going to use a bar chart of Bitcoin. Because, as I've told you before, I like being able to take the price off of a chart after I've drawn the moving averages. This, in its essence, is Consensio, just these two silly wavy lines. But now that you know that there's all kinds of other things going on behind these two wavy lines. They're not so mystical, I hope. And when I make comments like, it is very important at which point this wavy line, which is a 30-week moving average, stops going up, goes flat, and then begins to go down. In describing either a hyperwave or a bull market that has turned into a bear market, so that you can better picture when I say that my target from Hyperwave is 1,000, that even if it's up at 15,000 when Hyperwave says it's over and now it's going all the way back down, that there are many, many incremental steps between those big jumps of conclusions. And the last one has just come into play, which is why I wanted to do this Consensio vlog, since we have just turned down the long-term moving average, which is the last piece in the puzzle of a full bear market. Up until that turning down, that was not the case. And when we came to the phase 3 hyperwave line, this thing was still shooting up, this thing being a long-term moving average, with abandon. And you don't want to get too bearish coming from a bull market until you see this final piece in the puzzle. Now, I've taken the very short-term moving average off. I'm going to throw it back on just to make it a little bit easier to understand how all of this comes together in drawing conclusions. There's no price here, but now we've got something that's very similar to price, which is a 2-week moving average. And that 2-week moving average is going to be cutting up and down through the other moving averages much more frequently than when we are simply looking at what I call an intermediate moving average, in this case 7, and the long-term moving average. I'm now going to take the 2 away again and show you what a death cross really is. That's the death cross. And look how far back on this chart there is no golden cross. It occurred before. Using a 30 and a 7-week moving average, and I use weekly because that's what Hyperwave is based on, but you can use it for everything. You can use it for the stock market and the gold market and every other market. It's a great tool. But from time to time, throw on that real short moving average to remind yourself of all the incremental steps that are taking place. Remember, you're not looking at price here. Price screws you up when trying to make decisions about investments. That seems counterintuitive, but believe me, it is not. Here's the price. And there's all this noise all the time. There's all these going ups and going flat and going down and going up and going down and going up. And just imagine all the news items in each one of these bars. That's a week long. Just imagine what happened on the daily basis, in a 3-day basis, in a 12-hour basis, in a 6-hour basis. It's mind-boggling. It gets you fearful, and then it gets you greedy. And then it takes you back into a fearful state and back into a greedy state. Just get rid of this stupid thing. Just get rid of the price. It's true that that's where you're going to put your fiat money, but look at this chart. You should have been in this as both of the lines were going up, and that goes all the way back into 2016. And you should have gotten out of it close to that peak when the intermediate term went through all the incremental steps it took to, first of all, slow down its rate of ascent, then to go flat, and then to turn down. You should have gotten out of it, or at least you should have lightened up your position. I would not wait for the death cross to get out of the entire position. There are better ways to manage money between an intermediate term and a long-term moving average than either being black or white. The way to do it is as the short-term moving average, in this case, what I call a 2-week moving average, is considered or added to the punch bowl. Because now what happens is you get all kinds of clues from the short-term moving average as it drops sharply, tries to come back, and then drops through the intermediate term. Take something off the table. You don't know, and it does not matter, that if this turns around, you can get back into it with the small amount that you took out. But if what happens is it turns the intermediate term flat and then down, you can take a little bit more off out of the investment. Why? Because risk is growing and the reward is diminishing. And you can do that over and over again and never even look at price. That's why Consensio is so powerful. It's a different way of looking at the same thing that people that have been doing this for 10 or 20 or 30 years have done all along. But underlying what was really going on, it is masked by fundamental reports in earnings reports and political problems and financial problems and Federal Reserve policy and statements by people and crises at banks and all of this other stuff. But it always shows up in price first, and then it shows up in short-term moving averages, and then it shows up in intermediate-term moving averages, and then it shows up in long-term moving averages. And no, it does not matter which moving averages you use. Just space them out. Make them responsive to what is going on with the asset class you're looking at. People get too enamored with the details and don't step back and look at the bigger picture. Okay, I'm going to take the short term off again, so we can cleanse our mind of the details, which is the important thing about understanding trends. The reason the stock market is a great place to be is because for 100 and some odd years, it averages a 10% return per year. And it has a very consistent way of going up for a period of time, 2 to 2.5 years, and then correcting along with the economy for a period of time. The periods don't matter. The cyclicality of it does matter, and the winning formula of more up cycles that last longer than down cycles that last shorter is the key. When you look at other asset classes, that is not true. And when you look at very new asset classes like Bitcoin, if you get lost into either the theory and the philosophy behind it and become either totally turned off by it or totally turned on by it, you're missing huge opportunities in both directions. And this is one way of realigning your thinking about what you're looking at. Okay, so here you have the death cross. And by staying down for a period of time, the intermediate price activity began to slow the rate of ascent of the long term, and the long term then flattened out. But then look what happens here. As we go from 10,000 off this run from 6,000 back up to 10,000 that got everybody so excited, but it didn't get close to breaking through enough to do anything to Consensio. And then this rolled over as price dropped from 10,000 back to 6,100. This is accelerated back down. So just
Hey, Tyler, we lost you there for a second. Tyler? Hey, everybody in the live chat, can you...
incrementally,
okay.
yes.
Oh, hey, we lost you there for a little bit, Ty.
Am I back on?
You are back on, but we can't see you.
Oh, that's okay. I'm just looking at a chart. You can't see the chart?
Nope.
Okay, so what I'm going to do is I'm going to make this small. I'm going to click this little thing. I'm going to get out of screen share. And I am going to get out of this, and I will be right back.
Okay.
And the way
It looks like we kind of lost Ty again, but I think we're going to get him right back. This is like intermission in a movie. You guys rock. What are you doing? Okay, yeah. All right, we'll see when we get Tyler back. It should be like in 1 second. Ty, we got you.
How long was I gone? Was I talking for the last hour to myself?
Yeah, absolutely. All the most important, all your Nostradamus and everything. But now you're back and we can see you.
Okay, good. Because I'll start over again. Okay, so that's what I wanted to show everyone. What I'm going to do now is I am going back to screen share because I want to just talk for a minute about Bitcoin, because we always end our vlogs with what the heck is going on here?
Yeah, it's cut off.
Okay, so I did that wrong. I'm discombobulated.
Discombobulated.
Okay. We're going to try it one more time. Boom data.
I can always pull it up on TradingView if it doesn't come up this time.
Ooh, wow.
Oh, it's to infinity.
Ooh, cool.
Infinity and beyond.
Okay, let's do it one more time.
Okay.
Okay, so we'll do this one. We'll do this one. We'll do this.
We have like the most patient viewers in the world. Thank you guys. Let me see if it calibrates. But right now it's showing like half the screen.
It's not on. That's weird, right in the middle of it.
Would you be able to see my screen if I pull up TradingView?
Wait.
Yep. Try again.
I know what I'm doing.
Okay, that's a good thing.
Okay, here we go.
Yeah, we're taking interns for tech support, guys. Whoever wants to apply.
How's that?
Looks good. You got it.
Okay, great. So what we're going to do now is we are going to get rid of price again. No, we're going to change it to candlesticks. And then we are going to get rid of the moving averages. And we are going to look at dailies. And everybody probably, or many people probably listened to Leah and Tone and Jimmy's show earlier and heard the price. There's no change from yesterday or the day before, the day before, the day before in terms of where we are and what's going on here. We're in this little bounce from 61.20. Tone thinks it could get as high as 7,000. You know that I am neutral on a short-term basis in Bitcoin, and got head faked out of a long position after the SEC announcement came out. I thought that looked pretty good, but it was such a muted response that I took the long position back off and went neutral, which is where I'm sitting right now. So for the last 3 days, there's been basically no activity after that initial pop. And I'm comfortable being in a short-term neutral position. But think of what that means. This trading range between 6,200 approximately and 6,800 is a fairly small range, 600 points or about 10%. If you're in the middle of that range, you got 5% basically on both sides of you, either up or down. And the reason I'm neutral is we're sitting right in the middle at 6,711, closer to the top than the bottom. The closer we are up close around 6,800 or 7,000, the more I don't want to be telling people that I'm short-term positive. I'd rather be short-term positive. I love buying low and selling high, and in a trading range that runs just from either 6,000 to 7,000 or 6,200 to 6,800. Low means 6,200 down to 6,000, and we've been there and screwed around there for a while. high means up around 6,800, and we can't even make 6,800. So from my perspective, none of this short-term wiggling around has anything in the world to do with Hyperwave. All of this wiggling around has to do with all kinds of short-term oscillators and moving averages and Consensio. And as you can well imagine, what Consensio is saying is exactly what we just looked at, and that is that we are in a downtrend on a long-term basis. We are in a downtrend on an intermediate-term basis, and we've gone flat on various occasions from here to here for a week and a half, from here to here for almost 2 weeks, from here to here for almost 2 weeks, from here to here for almost 10 days. Those are flats. And they happen to be on the way up. If we look at a little shorter time period, on the way up to 10,000, this period, there's got to be a better way to look at that period. We could roll this, I guess. Okay. This period that took us from 6,000 up to 10,000, when you were going into flats, they were followed by movements up, and then flats and movements up. But when you are in a down short-term trend or intermediate-term trend, you go from down to flat, to down to flat, to down to flat. What is the next movement on an SAT test on the next move? The probability is it's going down. So it's very difficult for me when we're going through a flat period to get excited about telling people, okay, I see a 5% move to the upside. Okay, that's why I'm neutral. It has to do with Consensio. It has to do with what a flat means and what a pulse means. A pulse is the movement between flats. These are down pulses. The 5% up or 5% down from the last tick is a pulse that I look for, knowing what Consensio has told me the way markets move from short term to long, intermediate term to long term. So I just wanted to tie that all together and let you all know that I'm still watching Bitcoin very closely, but nothing's really going on. I will be in front of you with tweets as I see on a real-time basis between vlogs what's going on. But I hope you have endured this marathon. I hope it was informative in terms of what Consensio really is and how you can use it. I'm glad to bring it to you, and I'm glad to answer any questions people have about it directly. You can go through our website at lucidfunds.com. You can address things to me, Tyler, at lucidfunds.com, or Leah at lucidfunds.com. You can message me on Twitter. Thank you all for your patience as we made it through this with just a couple of technical glitches. And with that, I am going to turn it back over to my partner to say adios.
All right, up close and personal here, guys. Thank you so much for watching. This has been a fun one to introduce Consensio, and there will be much more. All right, thanks so much.
Thank you all. Bye-bye.
Bye.